Welcome back to the deep dive. And today, I have to be honest, I'm just genuinely confused.
That's a good place to start. I think that makes two of us.
We are staring at a set of financial documents that, well, they just shouldn't exist in the same reality. Welcome to Griffonomics.
Great to be here.
So we have this company, Oscar Health, ticker OSCR. You know them. They're the tech-forward, cool health insurance company.
The disruptors.
Exactly. And you look at their top line, their revenue, and you think, wow, they are absolutely crushing it.
They are. Revenue grew by 28% last year.
That's to nearly $12 billion.
Which is, and we should be clear, that's not startup money anymore. That puts you squarely in the Fortune 500 conversation. That's a serious, serious number.
It is, but then,
Yeah.
then you scroll down the P&L statement. You get past that big, shiny revenue number, and you see that in the very same year, they brought in $12 billion. They somehow managed to lose almost $500 million.
$443 million, to be precise. A net loss.
It's just, it's a staggering amount of cash to burn when you're already that big. But here's the part that really gives me whiplash. This is the confusing part.
Go on.
Immediately after announcing this absolute financial train wreck, which they politely call a reset year,
Of course they do.
they turn right around and promise investors that in 2026, they're not just going to stop losing money. They're not just aiming for break even.
No, they're promising a massive profit.
It feels like corporate gaslighting or something. It's like telling someone your house burned down, but don't worry, next year you'll own a castle.
It's a very, very bold claim. A swing of that magnitude in just 12 months. It's ambitious.
So that's our mission today. We're not just reading the press release. I want to understand the physics of this, the mechanics of the turnaround. Is this real? Is it just accounting magic?
Yeah, how do you actually pull that off?
Because looking at all this material, it feels like this is a story about a company at war with itself. It's a venture-backed startup trying to act like a tech company, trapped in the body of a heavily regulated insurance company.
And that friction, as you put it, it just created this massive explosion in 2025.
That's the narrative arc right there. You got 2025, the reset year.
Which is just corporate speak for we messed up badly and now we're taking all the pain at once.
And then you have 2026, the profitability year. This is where they claim hypergrowth, agentic AI, and some very aggressive math are going to save the day.
It's a two-act play. The disaster and the comeback.
So let's forget the stock price for a minute. Let's get under the hood. What actually broke so badly in 2025? Because reset year feels like a very polite way of saying dumpster fire.
It was, financially speaking, a total dumpster fire. And to get why, you have to focus on the single most important metric in the entire insurance industry.
The MLR.
The MLR, the medical loss ratio.
Okay, let's break that down for a second.
Please.
For anyone who isn't deep in this world, it's the cost of goods sold for an insurer.
Perfect analogy. If you run a restaurant, it's your food cost. If you're an insurer, it's the percentage of every single dollar you take in from premiums that you have to immediately turn around and pay out to doctors, hospitals, pharmacies.
So if I pay you $100 for my health plan,
And you go get a checkup that costs $80.
my MLR, or your MLR rather, is 80%.
Exactly. And that $20 you have left over, that has to pay for everything else. My salary, the rent, the marketing, all those software engineers and the ads.
Everything. So you want that number as low as legally possible, right?
Right. And in 2024, Oscar was doing great. They were at 81.7%. That's a healthy, sustainable business, almost 20 cents on the dollar to run the company.
Okay, that makes sense. But in 2025?
In 2025, the wheels just completely fell off. For the full year, it jumped all the way to 87.4%.
Which is already getting into the danger zone.
Very high. But that's not even the scary part. The source material points to an absolute horror show in the last 3 months of the year.
The fourth quarter.
In Q4 of 2025, Oscar's MLR hit 95.4%.
Wait, say that again.
95.4.
So for every dollar they took in, 95.5 cents went straight out the door to pay for care. Before they paid a single employee. Before they paid for their servers or their rent.
Correct. You're running the entire company on less than a nickel from every dollar of revenue. It is a business that is structurally, mathematically bleeding to death. You cannot survive that.
Okay. Why? What causes a jump like that?
The sources lay out a few reasons, but I want to start with the most technical and, frankly, the most counterintuitive one.
The risk adjustment.
The risk adjustment true-up. This single line item cost them $275 million in one quarter.
This is the part of the Affordable Care Act of Obamacare that everybody misunderstands, and it's exactly where Oscar got completely hammered.
All right, so walk me through this, because my simple brain says if I'm an insurance company, I want to sign up a bunch of young, healthy, 25-year-old marathon runners who never go to the doctor.
If I do that, I should be making a fortune. I'd pop the champagne.
And in the old days, pre-ACA, you would be. That was the whole game. But the ACA was specifically designed to stop that, to stop insurers from cherry-picking healthy people and discriminating against sick people.
So they built a system to prevent it.
They built a wealth transfer system. You can think of it as a forced Robin Hood mechanism inside the industry.
Okay, so if I have all the healthy marathon runners,
and your competitor, let's call them Acme Insurance, they end up with all the diabetics, the cancer patients, the people with chronic conditions.
they go bankrupt.
They would. So at the end of the year, the government looks at both of your books. They look at the risk score of your members, and they say to you, hey, your members are way too healthy compared to the market average. You had it too easy.
And then they just take my profits.
They take a massive chunk of your revenue and literally hand it over to Acme Insurance to help them pay for their sicker members. It's meant to level the playing field so that the competition is on price and service, not on who can avoid sick people the best.
So Oscar's big problem was that their members were too healthy. That just sounds insane.
Relative to the market average, yes. But here's the twist. The market average wasn't stable in 2025.
Right, something big happened. Medicaid redeterminations.
The big one. After the COVID emergency ended, states were allowed to start checking who was actually still eligible for Medicaid.
And millions of people got kicked off.
Millions. And a lot of those people, who often have more complex, untreated health needs, they didn't just become uninsured. They flooded into the individual ACA marketplace, the Obamacare market.
So the entire swimming pool got sicker. The average health of a person in that market went down.
Precisely. The overall risk score of the market spiked. But Oscar's specific book of business, their members, they stayed about the same level of relative healthiness.
I think I see it. It's not about how healthy your members are in a vacuum. It's about the gap between your members and everyone else's.
You've got it. That gap widened dramatically. So even if Oscar's members didn't change at all because everyone else got so much sicker, Oscar looked even healthier by comparison.
And the formula that calculates that penalty, that Robin Hood payment, is based on that gap.
It exploded. They got the final data from the government late in the year, realized the gap was way bigger than they'd modeled, and boom, they had to book a surprise charge for $275 million in Q4.
That's a brutal, brutal surprise. It's like being fined for being the only person in the office who didn't get the flu.
It feels that way from their perspective, but it's the law. And you combine that brutal payment with another factor they mentioned, utilization pull forward.
Which means people were just rushing to the doctor in Q4.
Exactly. They knew subsidies or planned benefits were changing, so they crammed in appointments and procedures before year end. You put that all together, and that's how you get to a 95% MLR.
Okay, so that's the pain. That's the bloodbath. That's the reset. So now the comeback. Usually a company that loses $500 million retreats. They lay people off, they pull out of markets.
It's a typical response, yeah.
Oscar's doing the exact opposite. They're promising 60% growth. How did they fix the math for 2026?
Well, if your costs are 95 cents on the dollar, you have two basic choices. You can try to lower your cost, which is hard, or you can raise your price. Oscar chose to raise their price.
How much?
They didn't just nudge it, they took a sledgehammer to it. They went back and refiled their insurance rates for 99% of their entire membership base.
And the increase was?
The weighted average rate increase for 2026 is approximately 28%.
Whoa, stop. 28%.
28%. Across the board.
My car insurance went up 8% this year, and I almost had a meltdown.
Yeah,
I was on the phone for an hour.
Yeah.
How do you raise prices by 28% and not have every single customer leave you overnight? That seems like business suicide.
It does, and that is the absolute core of their 2026 strategy. They knew they couldn't just pass that on to the consumer, so they played a very clever game of musical chairs with their plans. They call it the metal mix shift.
Right, the bronze, silver, gold, platinum plan.
Exactly. Now, look at the data from the sources. In 2025, 71% of all Oscar members were enrolled in a silver plan.
Which is usually the most popular, right? The middle-of-the-road option.
Yeah.
Moderate premium, moderate deductible.
It's the sweet spot for most people, but there was a problem. The enhanced government subsidies from the pandemic era were being reduced, which meant that for a lot of people, the out-of-pocket cost for those silver plans was about to skyrocket.
So if Oscar did nothing, their customers would open their bill in January, see a huge price hike, and immediately cancel.
Immediately. So Oscar's strategy was to proactively move people out of silver. And look at this shift. Silver plans went from 71% of their business down to just 36%.
That's a massive exodus. So where did all those people go?
They moved to the edges of the spectrum. Bronze plans, which have very low monthly premiums but high deductibles, they jumped up to 39% of the book. But the really shocking move was to gold.
Gold plans are usually the super expensive Cadillac plans, right?
Yeah,
Lowest deductible, highest premium.
they usually are. But Oscar did what they call strategic portfolio management. They designed and priced very specific, cost-effective gold plans, and their gold membership quadrupled, all the way to 25%.
Okay, cost-effective gold plan sounds like a complete oxymoron, like jumbo shrimp. How do you do that?
It's all about the complex interaction between the plan's sticker price and the government subsidy formula. By tweaking the plan design, maybe it has slightly higher copays for specialists or a narrower drug formulary, they were able to price these gold plans in such a way that for many consumers, after the subsidy was applied, the final monthly bill was actually cheaper than the new price of the silver plan.
So let me get this straight. The underlying strategy was, we absolutely have to raise our base rates by 28% to protect ourselves from that risk adjustment nightmare again. But we will hide that massive increase from the end consumer by shuffling them into different plan structures where the subsidy masks the true cost.
That is a cynical but 100% accurate way of describing it. It's about protecting the net premium, the amount the member actually writes a check for. As long as that number is still $0 or $20 a month, they don't really care that the underlying rate the government is paying on their behalf went way up.
It's a shell game, a very sophisticated, mathematically sound shell game.
It's portfolio management at a very high level, and the proof is in the pudding. They didn't lose customers, they gained them in historic numbers.
Let's talk about that gain, because gain doesn't even begin to cover it. The numbers here are just wild. It's a membership explosion.
It's the kind of growth you just don't see in a mature industry like insurance.
So they ended 2025 with 2.04 million members. As of February 1st, 2026, just about a month later, they announced they had 3.4 million members.
That's 1.4 million people in about 4 weeks.
Okay, now I have to ask about the elephant in the room here. For years, Oscar's big growth story was their partnership with Cigna, the Cigna plus Oscar plans. Did Cigna just hand them 1 million members on their way out the door? Is this some kind of accounting transfer?
That's the first question everyone asked, and it's a crucial point. The answer is no. That partnership officially ended on December 31st, 2024. It is gone. The Cigna plus Oscar membership number went to 0.
So this 3.4 million member figure is
100% organic growth. It's all direct Oscar sales through their own channels.
That is insane. How do you add 1.4 million people in a month without a giant like Cigna feeding you business?
You don't just partner with the brokers, you weaponize them.
Weaponize them? What does that mean?
Well, think about where the sales come from. The company says 90 to 95% of their members are enrolled via an independent insurance broker.
Right. The person you call during open enrollment.
Exactly. So Oscar expanded their broker partnerships by 60%, which is a big deal.
Yep.
But they didn't just give them brochures and say, hey, please sell our plans. They gave them powerful data tools.
What kind of tools?
Imagine you're a broker with 500 clients. Oscar gave 17,000 of these brokers a special software dashboard. That dashboard automatically scanned your client list and flagged every single person who was about to get hit with a subsidy reduction or a big price hike on their current plan.
So it identified the problem for them.
It identified the problem, and then it immediately presented the solution. It said, here is the exact Oscar Bronze or Gold plan that will keep your client's monthly payment low. Click this button to switch them.
That's brilliant. You're not selling, you're solving the broker's biggest headache. You're making their job incredibly easy.
You're turning chaos into an opportunity. They knew everyone was panicking about rising costs, and they handed the brokers a silver bullet.
But I see a catch in the notes. There's always a catch. The payment gap.
The fine print of hypergrowth.
Right. The company announced 3.4 million members, but the outline says management expects to settle at around 3 million paid members by the second quarter. So where are those 400,000 people going?
They disappear. They vanish into the ether of what's called non-payment churn.
Explain that.
A huge number of these enrollments, especially during the chaotic open enrollment period, are passive.
Meaning the person didn't actively choose it.
Right. Either the government's healthcare.gov system auto-renewed them into a similar plan, or it auto-switched them because their old 2025 plan was discontinued. The member might not even realize they've been enrolled in a new OSCR plan until they get that first bill in the mail.
And when you get a bill for something you didn't explicitly sign up for.
A lot of people just don't pay it. And in insurance, if you don't pay your first month's premium, your coverage is never activated. You were never really a member.
So Oscar is basically saying, we know about 400,000 of these members aren't real, and they'll wash out of the system in the first couple of months.
Exactly. The 3.4 million number is a great headline. It's a vanity metric. The 3 million number is the real revenue-generating metric that investors should be watching.
Okay, even so, growing from 2 million to 3 million paid members in a year is 50% growth. That's still huge.
It's massive, and that brings up the single biggest operational question they face.
How do you handle all those people?
Right. The old school insurance model says if you add 1 million members, you need to go hire another 1,000 call center reps, claims processors, care managers.
Your costs just scale right alongside your revenue.
Perfectly linearly. And if Oscar does that, they will never, ever be profitable. The math doesn't work.
And this brings us to the tech part of their pitch. This is section 4. The AI and technology moat, or, as I'm starting to think of it, the Oswell show.
Oswell is absolutely the star of their investor presentation.
We have to be really skeptical here, though. Every single company on Earth now says they use AI. I could open a lemonade stand tomorrow and call it an AI-driven citrus liquidity optimization platform.
And you'd probably get a $10 million seed round.
Probably. But Oscar CEO, Mark Bertolini, he's very insistent that this isn't just a buzzword. He uses a specific term, Agentic AI.
And that distinction is actually really important.
Okay, so break it down for me. What makes their AI Oswell? What makes it agentic versus just a really fancy chatbot like ChatGPT?
A standard chatbot is fundamentally a retrieval system. It's passive. You ask it, what's my deductible? It looks up your information in a database and it types back, your deductible is $5,000. It can read, but it can't write.
Okay, makes sense.
An agentic AI has been given permission to take action. It has, metaphorically speaking, hands. It can execute workflows. It doesn't just read the database. It can write to it. It can change things. It can initiate processes.
Give me a real-world example of Oswell doing a task that a human being used to have to do.
The best one they give is refilling a prescription. In the old world, you call in, you wait on hold, you talk to a human. That human has to pull up your file, check your eligibility, find your medication, check for refills, select the pharmacy, and then submit the order to the pharmacy system. It's like 10 steps.
This 5-minute phone call, minimum.
Oswell does the whole thing.
Yeah.
A member types refill my metformin into the app. Oswell authenticates the member, accesses their file, confirms the prescription has refills available, and then places the order directly with the pharmacy system via an API. There is no human involved.
So it's not just answering questions, it's completing tasks.
That's the key. It's completing multi-step, complex tasks, and the stat they're claiming is it's almost unbelievable.
What is it?
They claim Oswell now handles 86% of all member inquiries autonomously, from start to finish.
86%. That has to be inflated, right? Are we talking about complex coverage disputes, or is that mostly just people asking to reset their password?
They say it covers a very wide range, including clinical tasks like explaining lab results or checking for drug interactions. And the proof isn't just in that percentage. It's in their performance metrics.
Like what?
During open enrollment, the busiest, most chaotic time of the entire year, when call volumes go through the roof, they actually reduced the average response time for their human care guides by 67%.
Oh.
Because Oswell was deflecting 86% of the traffic. It freed up the humans to deal with only the most complex, nuanced problems.
So customers are getting faster answers and employees are less overwhelmed. But let's look at the financials. If this AI is so revolutionary, it should show up on the profit and loss statement as lower costs.
And it does. This is what they call their SG&A leverage story.
Selling, general, and administrative expenses.
Yeah.
Basically the overhead, the cost of running the business itself.
Right. In 2025, their SG&A ratio was 17.5% of revenue. For 2026, their target is to get that down into the 15.8 to 16.3% range.
So a drop of about 150 basis points.
It doesn't sound like much, but when you're talking about a $19 billion revenue base, every basis point is millions and millions of dollars falling straight to the bottom line.
And this is it, isn't it? This is the holy grail for them. If you can actually add 1 million paid members, but you don't have to add a corresponding number of support staff because your AI is handling the workload.
Then your margins explode. That is the moment an insurance company finally breaks the linear model and starts to look like a true software company. That is the moat they're trying to build.
If it works at scale.
It's a big if, but the data from Q4 and the open enrollment period suggests it's holding up so far.
Okay, let's bring this all home. Let's look at the full financial picture for 2026. We've talked about the reset loss in 2025. Now let's talk about the profitability promise.
The guidance they've issued is extremely aggressive.
Revenue first. They're projecting $18.7 to $19 billion. As we said, that's up about 61% year over year.
Just massive, massive scale.
But the bottom line, they are guiding for adjusted earnings from operations of between $250 million and $450 million. Positive.
So let's just put that in perspective. They're trying to swing from a roughly $396 million operating loss in 2025 to, let's say, a $350 million profit in 2026.
That's a turnaround delta of $750 million.
Yeah.
In 1 year.
It's staggering.
So what are all the drivers? We have the aggressive repricing. We have the SG&A leverage from the AI. What else contributes to a swing that big?
It's primarily the MLR correction. They're guiding for that medical loss ratio to drop from that disastrous 87.4% all the way down to a range of 82.4 to 83.4%.
That's a 5-point swing. On $19 billion of revenue, that's where almost all the profit is.
That's the whole ball game. And to make sure they get there, they're also being much more conservative in their budgeting for that risk adjustment payment.
How so?
Remember how they got burned because they assumed the market risk was lower than it was? For 2026, they are now assuming that risk adjustment will cost them 20% of their premiums, up from 18.5%.
So they're baking the pain into the budget from day one.
They're budgeting for the worst case scenario. They're saying, we're going to assume we have to pay out this huge amount. If it turns out to be less, that's just upside. But we will not get surprised again.
That sounds like a management team that learned a very painful lesson.
I think so.
And what about their cash position? Do they have the liquidity to handle this kind of growth?
They do. They have $2.7 billion of cash on the balance sheet. And they just announced a new deal with JP Morgan for a $475 million secured revolving credit facility.
So like a giant credit card. Why do they need that if they have almost $3 billion in the bank?
It's all about regulatory capital. This is the boring but absolutely essential part of running an insurance company. For every $1 billion in premium revenue you write, state regulators require you to hold a certain amount of surplus capital in a locked box just in case of a catastrophe.
So as you grow from $12 billion to $19 billion in revenue, your capital requirement goes way up.
Way up. That cash isn't for spending on marketing, it's a solvency requirement. The credit facility is just an extra layer of protection to show regulators they have more than enough capital to back their promises.
Okay, that all makes sense. It sounds almost too perfect. Everything is fixed, which means we have to talk about what could go wrong. Section 6, the risks.
And there is a very big one hovering over the entire industry right now.
Let's talk about the elephant in the room. Politics.
Specifically, the House GOP Judiciary Committee, chaired by Jim Jordan. They've just issued a round of subpoenas to 8 major ACA insurers.
And Oscar Health is on that list.
They are.
What's the allegation? What are they looking for?
They're investigating potential fraud related to the ACA's premium subsidies. There's a concern in some political circles that brokers or web platforms have been signing people up for these $0 premium plans who don't actually qualify, perhaps by misstating their income to get bigger subsidies.
They're calling it a program integrity initiative.
Right, and the subpoenas are demanding a huge amount of documents on subsidized enrollees and how the subsidy funding was handled between 2020 and 2025.
Now, we need to be really neutral and clear here. This isn't just an attack on Oscar. CVS, Centene, all the giants in this space got the same subpoena.
That's true. It's industry-wide. But Oscar is arguably 100% exposed to this market. It's their entire business. If the government, whether it's this Congress or a future administration, decides to tighten the eligibility rules or purge members they deem fraudulent.
Oscar's membership numbers could fall off a cliff overnight.
Exactly. If 10 or 15% of your 3 million members are suddenly deemed ineligible, that $19 billion revenue target just evaporates. It's a massive regulatory and political overhang.
It is. And then beyond that, there's just the straightforward execution risk.
Can they actually do what they say they're going to do?
Can they really hit that 82.4% MLR? What if the market gets even sicker this year than they've modeled? What if there's a new COVID variant or a nasty flu season?
Or what if their pricing model, as smart as it is, was just wrong again? If that MLR creeps back up to 85 or 86%, the entire profit story just vanishes into thin air. They are walking a razor's edge.
And what about the risk of those bronze plans?
That's a good point.
They just moved a huge chunk of their membership into these high-deductible plans. That's great when you're healthy. But what happens when those members actually get sick and realize they have to pay the first $6,000 out of their own pocket?
You get angry members, you get bad press, you get people who stop paying their premiums mid-year, which turns into bad debt for the company. It's a very delicate balancing act.
So we've gone through the disaster and the proposed comeback. We've reached the end of our deep dive, the outro. What is the final verdict here on Oscar Health?
Based on all the source material, the final rating is a speculative BUY, but I cannot emphasize the second part of that enough. High risk.
Okay, lay out the bull case. Why buy?
The growth is just undeniable. Projecting $19 billion in revenue when the market was expecting closer to $13 billion, you almost never see that kind of massive organic beat. And more importantly, the operating leverage from their AI platform, the whole Oswell story, it seems to be proving out in their SG&A targets. If they hit their MLR and margin guidance, the stock is deeply undervalued today.
And now the bear case. Why is it so high risk?
Because the entire turnaround thesis rests on two very fragile pillars: the accuracy of their 2026 pricing and the continued efficiency of that AI platform. If either one of those wobbles even slightly, the company could easily swing right back to a significant loss. And all of that is happening under the shadow of that GOP investigation, which is a total wild card.
So it's really a synthesis then. Oscar survived the reset year. They took their medicine. Now they are betting the entire company on the idea that their technology and their actuaries are smart enough to outmath the chaos of the American healthcare market in 2026.
The path from reset to profitability is all laid out. The math makes sense on a spreadsheet, but it requires near-perfect execution in a very imperfect world.
So I guess I'll leave you, the listener, with this final thought to chew on. Can an insurance company truly transform itself into a tech company? Can an AI agent like Oswell really decouple costs from growth forever? Or will the fundamental sickness of the market, the messy, unpredictable, and expensive reality of human health, always win in the end?
That is the multi-billion-dollar question.
Risk defined. Portfolio protected. Thanks for listening to Griffonomics.
See you next time.